Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. You know, I have to admit to you, the power of real estate is pretty impressive. Real estate has the ability to pay you 5 different ways. 6 different ways we're talking about multifamily real estate. And when you compare that to what you might be doing for investment, you'll find that real estate kind of has what you're doing beat. It really does. Because what you're doing now is probably this. You're probably hooked up with a 401k, or maybe you have an IRA, or maybe you're in a 403b, or maybe you have a SEP. But all of those things have one thing in common. They all revolve around the concept that you're going to take a portion of your earnings and you're going to deposit those earnings into that particular account. Now, some of those accounts give you some benefits. They may be taxed differently. In other words, if you talk about IRAs, there's the traditional and the Roth. One allows you to invest pre-tax, one allows you to invest post-tax, and there's rationales for why you should have either one according to your financial planner. But here's the thing. You're taking that money, you're putting it into that account, and that money stays there. You're allowed to invest that money into different vehicles. The biggest vehicle of choice is the stock market. Maybe you invest into mutual funds. Maybe your financial planner has you invested in different stocks. And there's flexibility within those accounts. But here's the thing. Any gains that you make on that money are put right back into that account. You're not allowed to touch that money, even though it's your money. That to me is the most surprising thing about those types of investment accounts, is that you cannot access your money unless you have permission. Now, the government is allowing people who were affected by COVID-19 to tap into that money. And there are different limits on how much you can tap into it. But here's the thing. If you tap into that money, what are you going to do with that money? Now, I believe the government tells you there are certain things that you should or should not do with that money. But again, they are putting rules on how you're to utilize the money, because the government does not believe that you can get yourself retired, that you need their help. See, the government formulated all of these different plans because they realize that most people who get to a point of retirement in their life can't live off of Social Security, that the government is finding other ways to subsidize those people in addition to the Social Security payments. Now, if we go all the way back to 1978, what happened then was a change in our laws with regards to retirement. See, back in those days, if you had a retirement plan, it was primarily in the form of a pension, and your employer was contributing money to a pension. However, they structured that pension. Maybe they invested in stock accounts. Maybe they invested in real estate. Maybe, who knows what they invested in. But the key thing was this. They were creating a pension for you that was designed to pay you after you left the company. And back in those days, loyalty between the employer and the employee, well, it was pretty much there. But in 1978, there was a change that occurred. See, there was a portion of the tax code under 401k. Yeah, there's no secret to why these things are labeled the way they're labeled. It's because the government has tax code that addresses these things. And under 401k, they allowed for individuals like you and I to have investment funds. And once big business figured out that they could shift the burden of retirement from something that they were responsible for managing and providing onto something that became your responsibility, it was game over. And in 1980, and those 401ks, they came into existence. Now, I think a lot of people thought, wow, this is really cool, because they thought, I can invest in stocks, I can invest in mutual funds, I can invest in all these different things that are allowed within that vehicle. And by doing so, I would have more control over my retirement. And I'm not sure that's really the way it's worked out, because the statistics that I'm looking at are clearly telling me that people are having a difficult time building those 401k balances up. I mean, according to CNBC, $203,600 is the average amount that Americans ages 50 to 59 have in their retirement accounts. And that's not a lot of money. It's really not a lot of money. And if you're one of those Americans that has about $203,600 in your retirement account, you really need to sit down and plan how you will utilize that money. Because as you get into the process of drawing down that money, as you're quote-unquote retired, you run the risk of running out of money, and that can be a problem. But real estate provides some very significant solutions for you. And we're going to talk about the 5 different ways we make money when we come back from the break.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. So I found it very interesting when I looked up how much money the government allows you to put into your retirement accounts. Now, the government does not prohibit you from investing directly into whatever stock fund accounts you want. I mean, you can have your own private account on any of the various different platforms out there that allow you to trade stocks. And there's no limit to the amount of money that you're allowed to put in there. But when it comes to things like IRAs, 401ks, 403bs, 457 plans, simple plans, those types of things, to include SEP plans, I found it very interesting that there were limits to the amount of money you can actually put into those accounts. For instance, IRAs, you're allowed to contribute $6,000 into an IRA account. That was according to tax year 2020. I'm not quite sure what the 2021 number is. I didn't bother to look that up because I don't invest in those things. But I think it's very curious that within something designed to be a retirement account, you're only allowed to contribute $6,000 into that account. Now, it does say on the source that I'm looking at that you can put $7,000 in if you're age 50 or older. And then they have a catch-up thing of $1,000. And I don't mean ketchup like ketchup and mustard. It's talking about catch-up contributions that you can make of $1,000. You know, it's kind of baffling to me because let's say you're 50 years of age, and let's say you decide you're going to invest into an IRA. You want one of those accounts. You, I, the people down the street, as far as I know, we can all get IRAs. And the type of IRAs is dependent on whether we want pre-tax or post-tax contributions. But let's say we're 50 years of age. We're going to invest $7,000 per year into that IRA. Over a period of 20 years, we will have invested about $140,000. And let's assume that the investments that we make, they grow over time. So whatever you're buying in your IRA is creating a return. And most financial planners are going to tell you 7 to 8%. Some will say about 10%. I mean, if you look at what the stock market is doing right now, the stock market is very healthy right now. And it's growing. Based on what I saw today, it's at new highs on the Dow. And the NASDAQ is back up right at its 50-day trading line. So it appears to be healthy. Appears, however. The market always appears to be healthy before it's not healthy. Yeah, it's just the way it is. But if you save $7,000 a year and you put it into that IRA, and let's say it grows at like 10%, assuming over time, maybe that IRA gets to, I don't know, let's pick a number. Let's go with, I like 170,000. We'll go with 170,000 because I don't know if you're going with a very safe and secure investment strategy. I don't know if you're going with an aggressive investment strategy. I don't know if you're middle of the road. I mean, consider the fact you're 50 years of age when you start and you are planning to contribute up until the age of 70. Chances are you started maybe more aggressive and you became more cautious as you went through the investing paradigm. So let's assume you have $170,000 in that particular account. You get to the age of 70, you've deferred all of your Social Security up until the age of 70, and you start taking that Social Security out. And let's say you get $3,000 a month in Social Security. Now, keep in mind, that's in the future. So $3,000 a month in the future will not necessarily buy what $3,000 a month buys today. That just has to do with the fact that prices have a tendency to increase over time. There is a thing called inflation that occurs, and money is measured based on a standard of $1972. Yeah, at least that's what I was taught. So you've got $170,000 sitting in that account, and you decide that you're going to draw that account down. And maybe, just maybe, you need an additional $3,000 per month to live. What will happen to your account is you'll start dwindling it down. You will start consuming that money, and that money will last you about 56 and a half months. Now, if we equate that to real years, it's going to last you a little over 4.5 years, meaning if you don't find a way to replenish that account at the age of 74 and a half, you're going to revert to just living off of Social Security. So all of a sudden, the lifestyle that you were sustaining in your early to mid 70s will now revert to just what Social Security pays you because you will have consumed all that money in that retirement account. Yeah. Real estate, however, has a different approach. Real estate allows you to utilize the money that you earn in the form of passive income, and we call that cash flow. And when you invest correctly into real estate, that real estate should be paying you 5 different ways. It should be providing you cash flow, and that's money that you can use to live off of. It should be providing you an opportunity to capture equity. You capture equity when you buy property at wholesale property prices, renovate the property, and then put it back in the marketplace, and it has a higher value. That's equity that you capture within the deal. Real estate also pays you in the form of appreciation over time. Appreciation over time is a natural function of real estate. Real estate tends to double in value every 20 years. You also have the benefit of the mortgage that you place on that property paying down over time. See, when you make your mortgage payment, a portion goes to principal and a portion goes to interest. And the portion that goes to principal is actually decreasing the amount that you owe. So it's actually going in the opposite direction of the appreciation of the property. The final way we make a lot of money in real estate is by taking advantage of the tax advantages afforded to us as real estate investors. See, the tax advantages allow us to use something called depreciation to offset the cash flows that we earn on the property. It's a really neat effect. When we come back from the break, I'm going to talk to you a little bit more about the money flow. Stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. So I'm looking at a bunch of different information talking to me about contribution limits that you can put into different retirement accounts that are out there. And when it comes to the 401ks, the 403bs, the 457 plans, there are limits on the amount of money you can put in. But there's no limit to the amount of money that you can deploy in real estate. No, there's really no cap on the amount of investments you can make. And by investing in real estate, you actually position yourself to get on a path to retirement in 5 years or less. Because you're allowed to do things with real estate that you can't do with your 401k or your IRA or your SEP or your Simple or your 403b or your 457 plan. Whatever you have out there for retirement. One of the scariest things that I think Lifestyles Unlimited members do is they sit down and they realize that their money has much greater potential for them if they deploy it into real estate. Yet a lot of them come to Lifestyles Unlimited doing what society said to do, which is to fund all of those accounts, because that's the conventional wisdom. That is what we have been taught. And many of our members come to us with a big chunk of change in those accounts because they have been doing what society told them to do for a very long period of time. But they hit a point in their life where they realize that it doesn't seem to be getting them to where they're trying to get to. And case in point, based on that CNBC data that I related to you earlier, Americans age 50 to 59 as of the fourth quarter of 2020, had an average amount in their 401k plans of $203,600. Now think about it. If you're in your mid-50s, you don't have a lot more time to continue to contribute to those plans because at a certain point, you're planning to retire. Waiting until the age of 70 to retire, that's a difficult thing for people to accept. Yet there are Americans out there that are working until the age of 70 or beyond. One of the other things that I noticed in that CNBC article was that Americans ages 50 to 59 are contributing about 10.4% of their income into those 401ks. And the trend line is that Americans ages 20 to 29 start at 7.4%. And then as the age population increases, and the graph that they have is 10-year blocks, that number tends to increase slightly over time until you get to that 10.4%, ages 50 to 59. But what if there was a different way for you to get yourself retired? And it could get you retired before the age of 70. Would you be interested? And I think you would be interested. If you think you need $6,000 a month to live off of, to provide you a basic lifestyle someday in the future, someday maybe when you turn age 70, and your game plan right now is to defer Social Security until as far in the future as you can, maybe to the age of 70, and maybe you'll earn $3,000 a month in Social Security, which means you're going to need $3,000 a month coming from somewhere else to give you that $6,000 that you need in retirement. Now, the problem with stuffing money into the 401ks and maybe the IRAs and those other plans is that you're consuming that money over time. And as I pointed out earlier in the show, if you had about $200,000, you'd run out of money at about 4.7 years, meaning you'd be 74.7 years of age, almost 75, and now you'd be forced to live off of Social Security income, and which may or may not provide you enough money to live your life. But what if you had 10 single-family properties? Just 10 single-family properties that you acquired along the way. And let's say you started at the age of 50. And where does that money come from for you to invest? Well, it comes from the same place that many of our Lifestyles Unlimited members find that money. It's in those retirement accounts. Now, it can be difficult for our members to actually tap that money because that's the sacred cow. They have been told throughout their lifetime that that is there to help them retire in the future. But when they start to do the math and they start to realize that that money will deplete, they realize that creating things like passive income is really a better road to travel. And when you correctly understand how to invest in real estate, you take a lot of the risk out of it. So if you took that $200,000, let's go with my number of $170,000. I'm going to go even easier. I'm going to say $170,000. And let's say you decided to invest in single-family houses. And let's say it costs you $25,000 per house. You would be able to buy 6 houses. And I'll round up, I'll go to 7. Let's say you're able to repurpose all that money and buy yourself 7 single-family houses. And all of those houses are paying you, on average, a cash flow of $400 per month. You would have $2,800 a month in cash flow coming in. And the majority of that cash flow is protected against taxation because you're allowed to depreciate those homes as they age over time, because the IRS says that those properties will wear out. Except when you follow the Lifestyles Unlimited model, you put that property into service as a rental property for a population of our society that desires to have great housing, and we provide it. You fixed everything that could go wrong in the next 5 years. So now you're owning properties. Instead of having money sitting in a retirement account, you're owning properties that are producing $2,800 a month in rental income, which you can use for anything that you want. You can set it aside to reinvest for more properties. You can use it to offset your ordinary expenses of life and maybe actually get yourself to a point of retirement now instead of waiting till the age of 70. Those properties are going to go up in value over time. And in the rare occasion that they do go down in value, you will be insulated because you have captured equity in those properties. You have a buffer there in case property values do fall. When we come back from the break, I'm going to spell it all out. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
So what I'm going to talk about in this segment is the concept that you get yourself properly educated on how to invest in real estate. And you take control and ownership over your investing journey. Instead of leaving it to your financial planner, leaving it to the rules that were created by the government, you actually repurpose that money. So if you were able to buy just 7 single-family homes, let's say you had that $203,000 sitting in your financial account, you're the age of 50, and you decide to tap into that. You can do it. You absolutely can do it. We actually have vendors that can assist you with getting that money out and avoiding the penalty, the 10% penalty that the government charges you if you choose to tap into that money. Now, we can't have you avoid any taxes due on that money because you're going to pay the tax whether you take it out now or you take it out later. That's unless, of course, you have some kind of specialized account where the taxes were paid up front so the money grows tax-free. That doesn't normally work in a 401k, though. If you were to buy, and I'm going to use current numbers, I'm actually going to use a blended rate of current numbers that I've seen from deals coming across my desk over the last 2 weeks. You can buy properties in today's market that will have an after repair value, meaning all fixed up. They would be worth $150,000 per property in the markets we invest in. That gives you a future value or an appraised value. And when I say future value, I don't necessarily mean like way in the future. I'm talking about when you get that property renovated and put back into service. That can be as little as a month or two. Now, I'm not going to suggest that you buy 7 houses and do 7 houses all at once. Although you could. We've had Lifestyles Unlimited members that have done that. I'm just going to suggest you buy one, you fix it up, you put it back in the marketplace, you go and get another one, you spread it out over a little bit of time. So maybe it takes you about a year to deploy all of this capital. At the end of the year, once you've acquired 7 houses wholesale and fixed them all up, the combined value of those properties should be in the neighborhood of $1,050,000. Now, purchase-wise, because you bought these properties wholesale and you use hard money assets, which allowed you to keep your cash out of pocket to as much of a minimum as possible. See, that hard money asset allows you to buy the property and to fund some, if not all, of the repair costs associated with getting that property renovated. You're looking at about $630,000 in total purchase price. That's assuming that you bought the properties for an average price of $90,000. Now, I'm going to estimate that your rehab on all these properties is about $35,000. So your rehab budget will be right in the neighborhood of $245,000. And you will capture equity amongst all 7 properties of around $175,000. You will need $175,000 to put into the deal. Now, earlier in the show, I mentioned I was using a 170 number. Okay, this is a little bit above the 170, but it's viable. And again, this is an example. I'm trying to give you an understanding of how this is going to work for you. So you deploy all of that capital, most of that capital, out of that 401k account, and you put it into these properties. You renovate the properties. You take out conventional financing on the back end as each one is remedied, as each one is put back into service, and you execute a 1-year lease with a great resident, because we teach you how to do all of that. You're now able to stabilize that property and put long-term conventional financing on it. Now, I will tell you that interest rates for investment properties are a little bit higher than what you would pay for your personal residence. But interest rates are still very, very low right now. And even if they adjust upward, they're still very, very low. These properties have the potential to pay you approximately $400 a month in passive income. Some might pay you more, some might pay you less. I've seen everything come across my desk anywhere from the neighborhood of around $300 a month in passive income to as high as $600 a month. Just depends on the property, depends on where it's located, depends on the condition. There's a lot of things that go into it. But $400 is a reasonable number that we're able to get in today's market. You would have $2,800 a month in passive income coming in. Annualized, you're looking at $33,600 in income streams. That's giving yourself essentially a $33,000 a year raise. Now, I'm not saying you need to quit your job at this point, but I'm saying this: if you started at the age of 50 and you spent 1 year putting 7 properties into service, at the end of 1 year, at the age of 51, you will have increased your income streams by over $33,000 per month, and that's just on the cash flow. Now, because you're allowed to depreciate these properties, as a matter of fact, the IRS pretty much mandates that you do it, you will take all the improvement values of the property minus the land cost, and you'll do straight line depreciation over 27 and a half years. That's the simple way to depreciate. There are other methodologies that can give you better depreciation numbers, but we're just going to go standard straight line. Your depreciation expenses on those properties would amount to $38,182, yet you only brought in $33,600. Meaning you still have $4,582 worth of depreciation that you can apply to other tax liabilities that you have in accordance with how the IRS allows you to do that. What I'm getting at is this: all $33,600 that you brought in is tax-free because of that depreciation. You're not going to pay taxes on that money. And you might be thinking, okay, well, I know real estate isn't completely tax-free. You know what? You're right. But real estate commands the most favorable tax rates in all of tax law. It really does. So the cool thing is this: let's say you hold that property or all of those properties for, let's just say, 3 years. And I'm going to give you some round numbers here. You would gain over $114,000 in additional appreciation on those properties as those values go up. So you will have taken properties that were worth $1,050,000, and over 3 years period of time, the value would now go up to $1,164,000. And that happens while you're operating those properties. At the end of 3 years, maybe you decide it's time to sell the properties. You decide to sell all 7 of the properties, which you can do. You would obtain almost $300,000 on the sale of all those properties. Now, you would be subject to capital gains taxes and potentially depreciation recapture taxes. That's where the taxes kick in. But what if you decide, you know what? I don't want to pay those taxes. I want to do a 1031 exchange. So now you buy a small multi-unit apartment community with that $300,000 that you have after selling all of those properties after about 3 years. And now you have an apartment community that's bringing you in potentially $6,000 a month. And you did all of that in literally less than 4 years. Imagine where your life would be as you continue to compound that over time. It's real, it's legit, and it works. And if you want to find out how we invest in real estate, go to freeworkshoplivestream.com. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.